Hello, my name's Jen Friend and I'm a tax manager at Friend & Grant. I'm going to talk about how to pass on property to the next generation without being saddled with a large tax bill. Over the years, we've worked with many people who have property as part of their investment portfolio, so we're very well versed in all aspects of property tax. We also work with many of our clients to reduce their inheritance tax liability. Usually the most valuable asset in the estate is the family home, and that's notoriously difficult to get outside the scope of inheritance tax, all the while you're still living there. That leaves the investment assets to use for planning, and it's certainly the case for many of our clients that properties form a large part of their investment portfolio. So is it possible to transfer properties down the bloodline and save 40% inheritance tax on the value without paying any tax? The quick answer is yes, it is, with careful planning. Let's take the case of a retired widowed gentleman, Jim, who owns a residential property but doesn't need the rental income as his pension income comfortably covers his living expenses. He bought the property 30 years ago for £50,000 and now it's worth £300,000. Jim has an adult daughter, Sarah, who is a single mum struggling to bring up her young son, Oliver, alone. Jim thinks it would be great to gift the house to Sarah. He'd love to help her pay the school fees and maybe even get to take Oliver abroad. How lovely it will be to see Sarah and Oliver get the benefit of the wealth he's worked so hard to create. He asks his accountant if he can gift over the property and is shocked to learn that he'll have to pay more than £80,000 in capital gains tax to do so. Jim simply doesn't have that amount of savings, so goes home disappointed. So what advice would we give Jim if he came to see us? Well, he could put the property into a trust for Sarah and Oliver's benefit. There are several advantages to this. He could hold over the capital gains, so no tax needs to be paid until such time as the property is sold. This gives an immediate tax saving of over £80,000. If Jim survives 7 years from the date he put the property in the trust, he'll have saved £120,000 inheritance tax too. Even better, Jim is safe in the knowledge that should Sarah get married and the relationship doesn't work out, there will be no way her ex could get access to the share of the property. Because it's owned by the trust rather than by Sarah personally, it will be excluded from a divorce settlement. And because Oliver is a trust beneficiary, some or all of the rental income can be distributed to him, making use of his personal allowance, and meaning in all likelihood the rental income would effectively be tax-free. There would be professional fees to arrange the trust, and the trust would need to submit annual tax returns. But Jim's delighted. He's saved £80,000 tax, and he's made his daughter and grandson happy. This is just one of a long list of tax saving ideas we have. Give us a call if you think we can help you with property tax or inheritance tax planning. Thanks for listening.